How does the rate story, the yield pressure, play into your expectations for what stocks can do here?
Yeah, I think it's a great question, and a lot of investors have been concerned about the recent move in rates. But we found that when we looked back and did some analysis, a lot of the big moves in interest rates that we've seen going back over the last 50 plus years have coincided with positive equity market returns. And if rates are rising for a good reason in the context of better economic growth, strong fundamentals, we have great corporate earnings, we think this is less of a reason to be concerned than if rates were rising for bad reasons, if there's a credit shock. But I think that it makes sense to pick your spots within the equity markets, and that's where we think it makes sense to avoid some of those bond proxies like utilities that you were mentioning, and as well as some of the stocks that are the high growth, no yield stocks whose valuations can be hurt by rising rates. So we like the middle of the spectrum, the half growth, half yield sectors, like industrials, like some of bigger tech, like financials, and these are the sectors that we think can do well in this rising rates backdrop.
Samir, I mean, obviously all this year we've had stupendous earnings growth, up more than 20% at this point. Maybe a third of that is the tax cut. The rest of it is a little bit more organic. And yet the market has been a little bit stingy in pricing that in. Obviously, the market's up about 8% year to date. Is that mostly about what's happening on the yield side to cap out valuations, or is there something else happening?
I think a lot of it was borrowed, last year. Last year we were up, I think, close to 20% on the S&P. So I think the market sniffed out, tax reform, especially in the latter half of the year. So this year's been a little bit more muted. And I think that's probably one of the biggest takeaways from interest rates is that, people need to manage their expectations, is that there will be gains going forward, but they will be more, tepid than they have been over the last few years because fewer sectors can do well in this environment of rising interest rates.
Jill, how do you see China's big move lower overnight? Yes, there was some catch-up playing. It was closed for the Golden Week holiday. But was that a delayed reaction to rising U.S. interest rates or escalating trade tensions?
Well, I think trade tensions are a concern, and broadly we've seen an environment where U.S. Has been outperforming the rest of the world. That spread has continued to widen. I think that while valuations for the U.S. versus the rest of the world are reaching spreads that we haven't seen since 2009, when you look at price to earnings ratios, what we're looking at here is for other regions you're still seeing analysts take earnings expectations down. So fundamentals haven't really bottomed in the rest of the world. So I think even though you've seen this stretched performance spread, in our view, the U.S. could continue to do well until we see those fundamental trends start to pick up.
Samir, do you expect to see a move in U.S. bond market yields when they open up in respect to what's happening in Italy today?
So if you track some of the proxies, if you track some of the futures markets, you're not really seeing very much of a response in the futures markets in terms of treasuries. Yields are still up just a tick in the U.S. If you look at some of those instruments. So again, the market's looking at Italy, but I think at the same time they're going, they will eventually resolve this situation. It's mostly political posturing.
Jill, you were mentioning that the earnings picture obviously continues to come through pretty well. There seems to be a heightened sensitivity right now, though, to what companies are going to be saying going out another quarter or two. We now have, the first quarter consensus for S&P earnings is supposed to be up 7%. So obviously a deceleration. So what specifically are you looking for sector-wise there in terms of profits?
Yeah, we're expecting overall earnings growth should decelerate slightly, but still remain very strong this quarter. So we're looking for 23% year over year. I think that even though profits growth is decelerating, that we found that that's not generally a reason to be concerned about equities. And guidance, as you mentioned, is going to be very important commentary this earnings season because, from last quarter, so far so good. Most corporates have been saying that either they're not concerned about trade, they're seeing limited impact, or it's too early to tell. I think this quarter will really start to get a sense now that we've seen obviously more tariffs come into place. And I think if we do start to see corporate outlooks deteriorate, that could be a risk to the CapEx recovery, where CapEx growth has been very strong and corporates are continuing to guide up there. So far so good. But from a sector basis, from our quantitative work ahead of earnings season, the sectors that have screened best ahead of this earnings season are industrials, healthcare, tech. Those are some of the areas that have seen strong revision trends, strong guidance, good results last quarter. Versus consumer staples and financials have ranked weakest in our models going into 3Q earnings season.